welcome to the Deep Dive. Today, we're tackling international finance. Specifically, we're going to help you get ready for that big meeting on globalization. We've got a dense textbook, a mountain of global economic data, and even some insights on currency risk. Are you ready to unravel some economic mysteries? Because honestly, even I was surprised by some of this stuff. Did you know that daily currency trading is way bigger than the value of all the goods traded in the world?
It's true. And it's one of the many fascinating aspects of international finance that often gets overlooked. But before we get ahead of ourselves, let's take a step back, just like our textbook suggests.
Right. It basically throws down a gauntlet and says, hey, before you get lost in all the fancy theories, you better understand what's actually happening out there in the real world. So let's set the stage.
The global economy is far more interconnected than most people realize. The textbook highlights the exponential growth of world exports over the past few decades. We're talking trillions of dollars flowing across borders every year.
It's kind of mind-blowing when you see it laid out like that. It makes you realize that what happens in one corner of the world can have ripple effects across the entire global economy. No wonder understanding international finance is so crucial.
And navigating this complex landscape requires understanding the key players. Institutions like the International Monetary Fund, or IMF, and the World Bank wield considerable influence on global financial policies. Their evolution has been marked by both successes and controversies.
So the IMF, it's like the world's financial superhero, right? Swooping in to save the day when countries face economic turmoil. But doesn't that create a bit of a moral hazard? If countries know they can always count on a bailout, might they be tempted to take bigger risks?
It's a valid concern. Imagine having car insurance and then suddenly deciding to drive with your eyes closed. Because, hey, you're covered, right? It wouldn't end well. The IMF faces a similar dilemma, providing a safety net without encouraging reckless behavior. And there have been real-world examples where countries, perhaps emboldened by the prospect of an IMF bailout, pursued unsustainable economic policies.
Okay, that analogy really drives the point home. So how does the IMF walk that tightrope? Do they have ways to ensure countries aren't just relying on them as a financial crutch?
It's a constant balancing act. The IMF imposes conditions on its loans, pushing countries to implement reforms aimed at addressing the root causes of their economic troubles. But it's a complex issue with no easy answers.
Makes sense. All right, so we got the big players and the potential pitfalls. But what about the nitty-gritty? The data that paints a picture of the global economic landscape.
That's where Chapter 1 of our textbook comes in. It's chock full of fascinating comparisons. The range of GDP per capita across countries, for instance, is truly staggering. Some nations boast a GDP per capita exceeding $50,000, while others struggle with less than $2,000.
Well, that's a huge difference. It really highlights the economic disparities that exist in the world.
Exactly. And unemployment rates reveal another stark reality. While some countries enjoy low unemployment, others grapple with rates above 20%. Take Spain and South Africa, for example.
Ouch, those are tough numbers. What factors contribute to such significant variations in unemployment?
It's a complex interplay of factors, ranging from government policies and labor market regulations to technological advancements and global economic trends. And then there's deflation, essentially negative inflation.
Wait, isn't deflation a good thing? Prices going down sounds like a win for consumers.
While it might sound appealing on the surface, deflation can signal underlying economic weakness. Think about it. If prices are consistently falling, businesses may postpone investment, consumers might delay purchases, and the whole economy can stagnate. It's a phenomenon that's been observed in places like Japan and Estonia.
Okay, so deflation. Not as rosy as it might seem. What else does this data tell us about the global economic landscape?
Well, it sheds light on some common misconceptions. For instance, there's a tendency to view trade deficits as inherently bad. But our textbook challenges that notion.
So it's not as simple as saying if a country is importing more than it's exporting, it's losing out.
Exactly. Imagine someone taking out a loan to invest in their education. They're temporarily in debt, but that investment is likely to pay off in the future with higher earning potential. In a similar vein, a developing country might run a trade deficit to import capital goods and technology that will ultimately boost its productivity and economic growth.
Interesting. So a trade deficit isn't always a red flag. Are there any situations where it does become worrisome?
Absolutely. The textbook highlights certain red flags, such as a high debt-to-GDP ratio or declining investment rates. These can signal that a trade deficit is becoming unsustainable, potentially leading to future economic problems.
Okay, so it's all about finding the right balance, investing for the future without jeopardizing long-term economic stability. But How do exchange rates play into all of this? I mean, it's not like countries are trading goods for goods anymore. There's a whole currency aspect that seems pretty complex.
You're absolutely right. The foreign exchange market, where currencies are traded, plays a crucial role in international finance. And it can be a wild ride. Just imagine the pressure of knowing that the value of your currency can fluctuate wildly, impacting the price of everything you import and export.
It sounds a bit like a high-stakes poker game. But instead of chips, we're talking about currencies that affect entire economies. Tell me, are there ways to manage that risk? How do businesses cope with this constant fluctuation?
Well, that's where things like forward contracts come in. Imagine you're a car importer and you're worried about the dollar depreciating against the euro, making those European cars more expensive. A forward contract allows you to essentially lock in today's exchange rate for a future transaction, protecting you from potential losses.
So it's like a financial safety net for businesses dealing with international trade.
Exactly. It helps them navigate the inherent uncertainty of the foreign exchange market. But even with these tools, the world of international finance can be quite unpredictable. It's not just businesses trying to navigate these currency fluctuations. The sheer volume of daily currency trading is mind-boggling. It actually dwarfs the value of all the goods traded globally each day.
Really? It's that much bigger. I would have thought actual goods being exchanged would be a bigger deal.
It's easy to assume that. But the reality is that a significant portion of currency trading is driven by investors looking to profit from those very fluctuations we've been discussing. They're essentially placing bets on which currencies will rise or fall, and that speculative trading has a massive impact on exchange rates.
So it's almost like a global casino.
Yeah. But instead of betting on roulette wheels or card games, they're betting on the fate of entire currencies. That's a lot of pressure.
Yeah.
So how do we even determine if a currency is overvalued or undervalued to begin with? That's where a concept called purchasing power parity, or PPP, comes in. You might have heard of the Big Mac Index. It's a lighthearted way of illustrating PPP.
Yeah, the Big Mac Index. I've seen that. Compares the price of a Big Mac across different countries. Is that really a reliable indicator?
Well, it's a simplified illustration, but it gets the point across. The Big Mac Index, and PPP in general, highlight that a Big Mac, while essentially the same product worldwide, costs more in some countries than others due to variations in the cost of non-tradable inputs like rent and labor.
So even though it's the same burger, the price reflects the different economic realities of each country. That's pretty clever. But I imagine using PPP for cross-country comparisons isn't always straightforward, right? There must be some limitations.
You're right to be cautious. The textbook provides a good example using The Economist magazine, even though it's the same publication. The price can vary wildly depending on where you buy it. This discrepancy highlights the fact that PPP, while useful, isn't a perfect measure of true purchasing power.
Interesting. It's a reminder that economic models and indicators can be helpful. But they don't always capture the full complexity of the real world. So we've covered exchange rates, trade balances, and now this concept of purchasing power parity. Where do we go from here?
Well, now that we have a better understanding of these core concepts, it's worth exploring how government policies can influence the global economic landscape.
You're talking about things like interest rates and government spending. I have to admit, that whole area of economics always seemed a bit intimidating to me.
It can be complex, but it's crucial to understanding how governments try to manage their economies. Let's focus on monetary policy for now. Specifically, those decisions made by central banks about interest rates and the money supply. These decisions have ripple effects that play out over time.
Okay, so if a central bank lowers interest rates, does that mean businesses and individuals are more likely to borrow and spend, potentially boosting economic activity?
Exactly. Lower interest rates can stimulate borrowing and investment. But it's not always a simple equation. A key factor to consider is the level of employment in an economy.
So, if a country is already at full employment, lowering interest rates won't magically create more jobs, right? It might just lead to inflation as people have more money to chase the same amount of goods and services.
You got it. It's like trying to squeeze more juice out of an orange that's already been squeezed dry.
Yeah.
But if there's slack in the economy, meaning there's unemployment, then lowering interest rates can encourage businesses to expand and hire, leading to actual economic growth.
Okay, that makes sense. It's all about finding the right balance, stimulating the economy without fueling runaway inflation. It sounds like a delicate balancing act. But what about the different ways countries manage their currencies on the global stage? I know there's a lot of debate about fixed versus floating exchange rates.
You're right. There are various exchange rate systems. The textbook walks us through a whole spectrum, from the gold standard to reserve currencies. crawling pegs, and of course, freely floating exchange rates.
Yeah. Chapters 11 and 12 felt like a whirlwind tour of exchange rate history. One thing that stuck with me was the story of the Bretton Woods system. It's like a real-life economic thriller.
Absolutely. It's fascinating how this system, intended to bring stability to the post-World War II world, ultimately crumbled under pressure.
Remind me how that all unfolded. It was something to do with the U.S. dollar, right?
Right. Under Bretton Woods, the U.S. dollar became the world's reserve currency, pegged to gold. And other countries pegged their currencies to the dollar. This system worked for a while, but the U.S. began running balance of payments deficits.
So they were spending more abroad than they were earning,
Mm-hmm.
leading to a buildup of dollars overseas.
Exactly. Countries started getting nervous, worried that the U.S. wouldn't be able to maintain the dollar's convertibility to gold at the fixed rate. This led to a run on gold, similar to a bank run. Eventually, President Nixon had to suspend the dollar's convertibility to gold.
So that was the end of Bretton Woods. It's amazing how one decision can have such a monumental impact on the global financial system.
It really highlights the interconnected nature of the global economy and the inherent difficulties of maintaining fixed exchange rates in a world where economic conditions are constantly evolving. Each system has its own pros and cons, and the choice often depends on a country's specific circumstances and goals.
I imagine there's no one-size-fits-all solution. But speaking of solutions, given everything we've learned so far, how do you see the current state of the global economy? Where are we headed?
Well, it's a bit like trying to predict the weather. There are a lot of factors at play. We're seeing rising inflation in many countries, persistent trade imbalances, and ongoing debates about the best way to manage exchange rates. And that's not even considering the geopolitical risks on the horizon.
Yeah, it feels like we're living in a time of unprecedented uncertainty between the war in Europe and rising tensions between the U.S. and China. It's hard to know what the future holds.
Absolutely. But even in times of uncertainty, there are always opportunities. And for those who understand the complexities of international finance, those opportunities can be incredibly rewarding. It all comes down to having the right knowledge and tools to navigate this complex landscape.
So knowledge is power, right? Especially when it comes to something as complex and ever-changing as international finance. But it feels like you need a PhD in economics just to scratch the surface.
You don't need a PhD. But a willingness to learn and ask questions definitely helps. And remember, the goal isn't to become an expert overnight. It's about gaining a foundational understanding of the key concepts so you can connect the dots and see the bigger picture.
Right. It's about being able to understand those financial news headlines a little better, or maybe even hold your own in a conversation about the global economy. Speaking of headlines, have you been following the recent debate about whether certain currencies are overvalued or undervalued?
That's a discussion that's always swirling around in the financial world. It seems like everyone has a different opinion. One expert will say the dollar is too strong, another will argue the euro is weak, and then there's the whole debate about the Chinese yuan. It can be quite a whirlwind.
It's enough to make your head spin. How do we even begin to sort through all those conflicting opinions?
Well, remember those concepts we discussed earlier? Purchasing power parity and trade balances. They can provide a framework for understanding why currencies might be considered overvalued or undervalued.
Okay. Reminding me how those concepts connect to currency valuations.
If a country's currency is considered overvalued, its goods and services become relatively more expensive compared to other countries, potentially leading to a trade deficit, as imports become more attractive and exports face stiffer competition.
So, it's like a seesaw effect. A strong currency can boost imports but potentially hurt exports. And if a country's currency is undervalued, it makes their exports more competitive on the global market.
Precisely. An undervalued currency can lead to a trade surplus. But, as we discussed before, trade imbalances aren't inherently good or bad. It all depends on the specific context and the long-term economic goals of the country in question.
It seems like context is everything in international finance. You can't just look at one piece of data or one indicator in isolation. You have to consider all the interconnected factors at play.
You're absolutely right. It's like trying to solve a puzzle without all the pieces. We've explored some of the key pieces of the international finance puzzle in this deep dive. Exchange rates, trade balances, purchasing power parity, monetary policy, and the different exchange rate systems countries can choose from.
Yeah, my brain is definitely feeling a bit full, but in a good way. I feel much more equipped to navigate conversations about the global economy. Maybe I'll even impress a few folks at that globalization meeting.
That's the goal. Remember, learning about international finance is a journey, not a destination. The more you explore, the more you realize how much more there is to learn.
Well, I, for one, am feeling a lot less intimidated by this whole subject. And who knows, maybe I'll even dive into some of those more advanced topics in the textbook now that I have a better grasp of the fundamentals.
That's the spirit. Keep asking questions, stay curious, and keep diving deep into the world of international finance. It's a fascinating subject with real-world implications that affect us all.
And if you're ever feeling overwhelmed by it all, remember, the deep dive is always here to help you make sense of the world, one fascinating fact at a time. Until next time, stay curious.